Welcome to Oregon Cash Flow Pro. My name is James Barber. I'm always here to help you maximize your cash flow. Today, we're going to be looking at a comparison between Guardian's 10 pay and L99 for a 31-year-old male. We're going to look at the numbers for the specific funding for this client and see how it compared using the L99 product and the 10 pay. This can be valuable when thinking about what you want to do with your policy. I'm trying to give you guys some ideas on different things that can be done and some of the steps that we go through to help find the best product and the best design for your situation. So let's jump right into it. First, I'm going to show you the actual results. This is for the L99. We call this a long pay. With this client, we actually looked at the L99 with a short pay period, a long pay period, the L95 with a short pay and a long pay, and then we looked at the 10 pay product. So different products, very similar designs. The goal was cash value in this case, not death benefit. We end up getting a good amount of death benefit regardless, but the deciding factor generally comes down to cash value. And in this situation, that was what we were trying to figure out. But we're going to look at the comparisons among all the different metrics here. So here's the numbers. I'm just going to scroll through these so you can see them. And then I'm going to be transferring these over to a spreadsheet. And here's the numbers for the 10 pay. Again, I'm going to scroll through these so you can take a look. And then we're going to pull these over to a spreadsheet so we can compare them easily. All right, here's our spreadsheet. If you want to take the time, we're going to scroll through these. These match what I just showed you on the other page. You can see we're tracking policy year, age, how much cash went out, the cumulative cash, so what you've paid each year, but adding it up, the guaranteed cash value, guaranteed death benefit, face amount of 1-year term, net cash value, net death benefit, internal rate of return on cash value, and internal rate of return on death benefit. This is the 10 pay. This is the L99. So we just verified that we have the same numbers plugged into each spreadsheet. So what I did was I took a third spreadsheet and I said, what is the difference between the max funded 10 pay and the max funded L99? And we just subtract the difference. And these are the results. Briefly, let's look at the actual 10 pay and the actual N99 because there's a couple of things we look for when we're trying to design these for cash value. Number one, we're going to look at break-even period. So if you put in 20 grand, you get 15,488 end of year one. And our break-even is when the net cash value surpasses the cumulative outlay. And we can see that happening here in year 6, right there. We see that happen here on the internal rate of return. Internal rate of return means this percentage is the equivalent of this policy earning that percent every year prior. So we start off with a negative internal rate of return because we had less cash value than we paid into it. By the next year, we have a lower negative internal rate of return, but this is the equivalent if our rate of return was negative 9.82 each of the last 2 years. Make sense? So by the time we get well into the policy, let's look at right here, age 89, we've got a 4.7% internal rate of return. That's the equivalent of earning 4.7% every year prior in the policy. So we've overcome the initial losses, and it just gets better and better and better every year as the policy gets older. And this is what we see in whole life. This is what we should expect to see, and this is based on the current dividend rate. These numbers are based on the current dividend rate. Now, the guaranteed numbers assume no dividend gets paid ever. It's just based on whatever the guaranteed rate is for that product. For the 10 pay, the guarantee is 2%. And for the L99, the guarantee is a 3% growth. Here's the L99, and we have a break even in this product at year 7. Now, these can be designed to break even sooner. That generally entails a shorter funding period because we don't need as much death benefit. We have more death benefit in this case, so our internal expenses are a little bit higher because we're paying for more death benefit, and thus the break-even period is extended a little bit. It's not terrible by any means. Year 7 break-even is not bad, okay? And our internal rate of return ends up being a little bit lower than what we got in the 10-pay product. So it looks like we top out 4.53, 4.54 here at age 78. Whereas on the 10-pay, at that same time period, we're at 4.7. And it gets up to 4.71 a little bit later. Let's look at the comparison between the two. Now that you know the numbers, you can see the values. How do these compare? Cash outlay, you can see for the first 18 years is exactly the same in both products. On the guaranteed cash value side, this is a negative number. So that means the 10-pay is underperforming the L99 from a guaranteed basis. That makes sense since we have a 3% guarantee on the L99 and we have a 2% guarantee on the 10-pay. Well, what's the likelihood that we're going to realize the guaranteed values in this? It's not very high. Guaranteed assumes no dividends ever, and Guardian's been paying out greater than the guaranteed amount, so a higher dividend than the guaranteed amount for 180 plus years. So not likely that we're going to see the guaranteed, but the guaranteed one is still interesting to pay attention to. Because at some point, even with that guarantee, we do pass the break-even period. We're not worried about that because we don't think that's really going to come into play. Let's compare the actual cash values. So year one, the L99, when we see a negative number, that means the L99 is doing a little better. So there's more cash value in the L99 at year one. But beginning in the next years, the 10-pay ends up with more money every single year for the rest of the time. So we have more cash value in this product. It's not a big difference. This is not large differences, right? We're putting $20,000 a year into this thing. But by year 18, we've put the exact same amount of money in both. The 10-pay's got $11,000 extra dollars. This is not a huge difference. The internal rate of return is very similar on both of these products, but the 10-pay is a little bit better on all these, except for that first year. Okay, so slightly better internal rate of return. What happens after year 18? This is a max fund design. How much money can we continue to put into each of these products? We can't put as much money into the 10-pay as we can the L99. So we can see this being a negative number means we put $8,000 less dollars into this product. The next year we put, this is cumulative. So let's go with the actual cash outlay. So we put $8,900 less. And then in the next year, it's only $1,600 less. And then we're able to start funding the 10-pay at a higher amount by $1,000. Well, the cumulative difference comes down, 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 and eventually we can start funding the 10-pay at a higher amount. A lot of times I will hear people disparage the 10-pay product by saying, you can't put as much money into it. Why do you want to limit the amount of funding you can do to 10 years? Well, with the Guardian 10-pay, you're not limited. This 10-pay product, when we have term insurance blended in with it, which is the case here, we're able to continue putting in paid up additions. This is no longer base premium payment after those 10 years. The base has been satisfied. Now the base in this product was $5,000. So that 10-pay was based on a $5,050 of base whole life insurance. And the rest of it, we're buying paid up additions and paying for a little bit of term insurance. Well, after year 10, that base is satisfied. That 10-pay product is done being funded at the base level. And so now it's all paid up additions that are dumping into there. And notice our internal rate of return jumps and it starts to climb a little bit quicker. Well, at some point, we run out of term insurance. And that's just the way that Guardian works, okay, in this type of blended design. Every time we're buying paid up additions, we're replacing some of that term insurance. Once that term insurance is gone, I can't dump in $20,000 anymore. I have a year where I can put in 11, and then it's just going to let me match the base amount. So we can still continue to fund it, but just at that base level. But this is not base insurance. This is paid up additions that we're continuing to dump money in. So back to the comparison, or let's look at the L99. What happens when we run out of term insurance on the L99? Well, we're essentially limited to the base plus double that or equal to that in paid up additions. So we're able to put in $4,000 a year at that point. So we can put in $5,050 on the 10-pay but we can only put in $4,000 each year on the L99. Now we can still get a lot of money into both of these policies. It's not like we're going to be hurting. We're getting hundreds of thousands of dollars into here. By age 85, we got $526,000 we put into the L99 and $552,000 on the 10 pay. Those are pretty good numbers. That's a lot. Now we can design these things different. We can design it to accommodate what you're trying to put into it. With this particular client, this was his goal on funding. Put in $20,000 a year, as many years as he could. Keep funding it at whatever it will allow. And this is going to serve as their infinite bank. The cash value is available to borrow against throughout his life at a 4.76% interest rate, and it's not going to stop the compounding growth. It's still going to continue growing even if you're borrowing against it. Back to the comparison. The death benefit. This is the biggest difference between the two. The cash value wasn't a whole lot different, at least not in the early years. And it doesn't get really big until we get past age 60, right? I mean, it just keeps going up. And the cash value difference becomes more and more apparent in the 10-pay product with the max fund design. By the time he gets to age 85, we've got an extra $300,000 in the 10-pay. Well, early on, the death benefit is a lot higher in the L99, almost $450,000. And it stays higher it stays up near that amount for almost 20 years, and it remains hundreds of thousands higher in death benefit throughout their 50s and 60s. It's not until age 82 that the death benefit in the 10-pay finally surpasses the death benefit in the L99. Well, this person's 31 years old right now, and they're very healthy. They got a good health rating. They got the best health rating. The average age for a man to survive is going to be into their mid-80s. So if you want to optimize for cash value and based on traditional longevity, the death benefit, the 10-pay is going to be the better product in both of these scenarios. But if tragedy were to occur earlier on, the L99 gives you better death benefit. Now, I'm not going to make a decision on which one of those you should prioritize. That's for you to decide. But you need to have the right information to help you make the decision that is going to be best for you. Do you want a higher death benefit? During these early years, there could be a lot of value in having that extra death benefit. That extra death benefit could be met by buying a separate policy, or maybe you own another policy that helps you get the death benefit that you want. In this case, this client was just focused on the cash value. He doesn't expect to die early, and if he does die, the death benefit that pays out is still really good. So it isn't really a concern as to whether his beneficiaries gets $1.45 million or just over $1 million. Not really a big deal because he's using this for the cash value. So in this situation, the client opted to go with the 10-pay, and we did get them approved, and that policy is now in force. Now, I did meet with somebody today. Different situation. This is a female, a little bit older, and we did the same comparisons, and the 10-pay was slightly worse than the L99, even in cash value way down the road. Cash value, death benefit. And so it didn't make sense to recommend the 10-pay in that scenario. So for whatever reason, when the circumstances change, the funding changes, the age, the gender, it can give us different results. So it's important that we actually run the numbers on these products and see which one might work best for you. You don't necessarily want to go in, meet with an insurance agent and say, I want the L95 or I want the L99 because you think that that one might work best for what you're trying to do. We are the experts on these products and figuring out what might work best for what you're trying to do. Whether it's cash value, death benefit, mix of the two. Do you want more cash value in the beginning years? Is it more important to have cash value higher in the later years? Those are all the things that we're trying to figure out and solve, and we bring our experience to bear to make that happen. So I hope these videos that we do help you out and help you understand what's going on in these products. And if you're not working with me, if you're working with a different agent, you kind of have an idea of what you're looking at and how you can compare these things. Now, I welcome you to schedule a meeting with me if you'd like to see what I have to say, if you'd like to see my recommendations. I'm always up for doing any reviews. If you already own a policy, we can look at it, see if you're using it to the best of your ability. That's always our number one goal, is to utilize whatever we currently own to the best of our ability, optimize the use of it. But if maybe you just have an illustration that you got from somebody else and you want to see if I can design something better, schedule a meeting with me. My Calendly is always open to you folks, and I'm licensed in over 40 states. So odds are I can help you if you decide you want to work with me. Appreciate you joining us for this video. If you have any questions or comments, be sure to leave them in the comment section below, and we'll do our best to answer them.
Hope you found value in today's video. If you'd like to find out more about IUL and the whole life, check out these videos right over here, and we'll see you next time.
Now go maximize your cash flow.